Now, there are three key points which I want you to remember about interest rates. The first is that interest rates are not freely determined by the market. This is what I explained in my previous video. Interest rates are determined, interest rates are essentially determined by the central bank of any particular country. They are the ones who set the interest rates. The financial system or the banks of that particular economy take up the interest rates set by the central bank and conduct their business based on the interest rates set by the bank. The second thing that one needs to remember about interest rates is that inflation is the key determinant of interest rates. Because as I mentioned before, that the mandate or the objective of any central bank is first and foremost stable prices of goods and services in the economy. And to maintain stable prices of goods and services, to keep inflation under check, central banks use interest rates as the most important tool to control inflation. Generally, when inflation increases, central banks tend to increase the interest rates to bring the inflation down. The other important point that one needs to remember is that interest rates are powerful tools to control the money supply in the economy. Why? When interest rates go up, then agents with excess capital find it better or find it more attractive to save the money for future spending. Because the interest rates are higher, they're going to get a higher return. So they will reduce their spending now and will save the amount of money for future spending. With the reduction in the amount of, when they start putting away the money, when they start saving the more amount of money, that is going to reduce the money supply in the economy, and that is also going to reduce the amount of aggregate level of demand in the economy, because interest rates is sort of incentivizing people to save more and spend less now, which is going to bring down demand in some cases and also the amount of money supply in the economy. So these are the three key points to remember when one is talking about interest rates. So that interest rates are not freely determined by the market. There is a market which sort of determines the interest rates, but the base level is set by the central bank. Central bank essentially focuses on inflation and then decides upon what interest rates to set. And the central bank also uses the interest rates to control the money supply in the economy. By increasing the interest rates, they incentivize people to save more. They also incentivize banks to save more with the central bank, which reduces the total amount of money supply in the economy. Now, why do interest rates matter so much? Because whenever we talk about economy and economic growth, interest rates always figures as a key factor. Why is it so? And the simple answer to this question is that cost of capital, or the price that one needs to pay to raise immediate capital for investment needs or consumption needs or whatever, is closely related to interest rates. If interest rates are high, the cost of capital is higher. So if suppose you wanted to start a company, or if you wanted to invest somewhere, if you wanted to expand suppose you're an entrepreneur, you have a business and you want to expand, if interest rates are high, you would have a reason not to do so, because you'll be paying more for the money that you borrow to expand your business. And for a growing economy, this sentiment is really bad, because when people do not want to expand their businesses, when people do not want to grow, that has a direct effect on the total economic growth of the country. So higher interest rates is seen as a negative for the economic growth, for the long-term economic growth of a country. So this close relationship between interest rates and economic growth is very important. And that is the balancing act that central banks needs to play, because they know that if they keep increasing interest rates very high to control inflation, that might at some point start affecting the economy, because now people Because of higher interest rates, people would not be willing to borrow money to grow their businesses or to engage in more economic activity. And this is the crucial reason why interest rates are so important in an economy.